Most people who enjoy tracking Warren Buffett's investments know that the Oracle of Omaha is a major fan of dividend-paying investments. The dividend holdings held by Berkshire Hathaway have played a big role in the overall returns of the company for many decades. Of the 49 stocks in Buffett's portfolio, 31 of them currently pay dividends, and he's estimated to have collected more than $6 billion alone in 2023. This number has continued to grow over the years as Buffett collected just above $6 billion in dividends in 2022, $5.06 billion in 2021, and $4.89 billion in 2020. It's important to know that Buffett's love of dividends isn't new, but that he's been a fan of dividend-paying investments for decades. According to Rich Duprey from Investor Palace, since becoming CEO of Berkshire Hathaway in 1965, Warren Buffett has generated 3.7 million% returns for investors. In comparison, the S&P 500 returned 24.7,000%. Although both are really impressive, it's obvious that Warren has been the overall better investor by a significant amount. It seems clear that he's very much aware of the power of compounding dividends and their importance when it comes to overall returns. I've shown this graph before, which shows the overall returns of the S&P 500 when dividends were taken into consideration as opposed to not being factored in. Over time, dividend-paying investments in the S&P 500 have been a significant source of total shareholder returns. Through the years, Warren's held a lot of dividend-paying stocks, including some that are specifically designed to pay high amounts of dividends, including real estate investment trusts. In 2017, he invested in Store Capital, picking up about 9.8% of all outstanding shares of this company. This stock was actually one of my favorite REITs before it was acquired and delisted in early 2023. If you include the holdings held by New England Asset Management, which is a subsidiary of Berkshire Hathaway, they hold other high-yielding stocks, including business development companies. But Warren recently made headlines when he went on a $600 million buying spree into a sector that's known for paying large dividends, which is the energy sector. According to an article on Investors.com, Warren Buffett has been loading up on Occidental Petroleum stock in the days following the energy company's $12 billion Permian Basin acquisition. The billionaire investor bought in at a price that has served as the support level for OXY for the past 18 months. Buffett spent $588.7 million on more than 10 million shares of OXY between December 11th and December 13th, with a price range of $55.58 to a fraction more than 57, according to a regulatory filing late Wednesday. Warren Buffett purchased more than 5 million OXY shares on December 12th, the day after Occidental Petroleum announced it agreed to purchase privately held Permian Basin oil producer Crown Rock in a deal valued at around $12 billion. The purchase will be the company's first major acquisition since 2019. Buffett bought those OXY shares at $55.18 per share. Occidental Petroleum Corporation engages in the acquisition, exploration, and development of oil and gas properties in the United States, the Middle East, North Africa, and Latin America. It operates through three segments, which are oil and gas, chemical, and midstream. On top of investing in this company, Warren also owns Berkshire Hathaway Energy, which is a subsidiary of Berkshire that owns an impressive list of other energy companies, including Mid-American Energy Company, Pacific Corp, and Northern Power Grid in the UK. It's also pretty well known that Warren is also a shareholder of Chevron Corporation, ticker CVX, and has been since 2020. Recently, though, he has been trimming down his position in this company for the past few months. Despite that, though, Berkshire Hathaway Energy continues to expand into more investments. In July of last year, they bought a 50% stake in the Cove Point Liquefied Natural Gas Facility in Maryland for $3.3 billion from Dominion Energy, an East Coast energy corporation. With all this in mind, it's no secret that Warren loves energy companies. They're a defensive sector, meaning that they're less impacted by recessions as people still need energy regardless of how well the economy is doing. Additionally, they're protected by government regulation, which also helps stabilize them. But despite being a defensive sector, many energy and utility companies have been really negatively impacted by rising interest rates. This is because oil and other utility companies, including communications, sewer, water, and solar companies, have larger infrastructure expenses. Things like oil rigs and pipelines are very expensive to buy, repair, and upgrade, and usually requires companies in this sector to borrow large amounts of money to do these things. With interest rates increasing, it does become more expensive for these companies to borrow money to perform these regular functions. So it's not uncommon for energy and utility companies to slow down on these things until rates go down. If we look at the S&P 500 Utilities Index going back to 2014, you can see this sector did see consistent growth. Again, not as much as other sectors like technology, but it was still very consistent. When the pandemic hit, the sector took a hit along with everything else before eventually recovering to an all-time high. But then in 2022, when the Fed started increasing interest rates, things started to go downhill across the whole sector. Interest expense would grow for companies who had no choice but to borrow to repair or upgrade their assets. Some companies would instead issue new shares of their stock to pay for these things, which drives down the share price of their stock because of share dilution. As time goes on, this sector continues to struggle as many investors are still waiting for rate cuts to invest. But as investors should know, when it comes to picking investments, it's always better to buy when companies are on sale, not when they're at an all-time high, like what we're seeing with tech stocks. And what's even better is that many companies in this sector pay generous dividends to shareholders. Because these companies don't see explosive growth like tech stocks do, they usually offer a perk to investors that are also offered by many consumer staple stocks, which are higher than average dividend yields. It's not uncommon to come across energy and utility stocks that come with dividend yields exceeding 4 or even 8% or higher, and many of them still offer dividend growth. So let's take a look at some energy stock types that exist, as well as some specific companies in this sector that offer generous dividends. When it comes to energy stocks, first you have, I guess, just typical individual companies. These are regular stocks within the energy sector that aren't specifically designed to pay higher dividends, but some of them still do, and they typically see the most amount of growth with their dividends. All of the major oil and gas companies, including Exxon, Chevron, Shell, and ConocoPhillips, all pay dividends ranging from around 2% to over 4%. Then you also have energy transportation stocks, which are companies that are more focused on infrastructure, such as pipelines that transport oil and natural gas. Some options include TC Energy Company, Enbridge, OneOak, and Enterprise Product Partners. An entirely different kind of investment that exists within the energy sector are called royalty trusts. Royalty trusts generate income from the actual production of natural resources and pass on a significant amount of the income to shareholders. These are pretty uncommon investments because they're extremely cyclical and they're only attractive during periods of rising commodity prices. A positive, though, is that pretty much all of them do pay monthly dividends. If we look at the dividend history of a typical royalty trust, you can see that there can be some pretty significant swings between one month to the next. So these are usually only going to pay good dividends when oil prices are rising. But when prices are in fact rising, you can find some royalty trusts that are yielding over 15 and even 20% in some instances. Some examples of royalty trusts out there include Permian Basin Royalty Trust, Mesa Royalty Trust, Perm Rock Royalty Trust, and San Juan Basin Royalty Trust. Although some of them are still paying decent dividends, both their share prices and their distribution amounts have been cooling off pretty significantly in the last few months. Another type of investment we'll cover in the energy sector are master limited partnerships. These are actually somewhat similar to royalty trusts in that they're able to provide more consistent dividends than a royalty trust can. So they add some stability, which are more ideal for long-term holders. With special tax considerations, you'll need to research first before investing. Some examples of MLPs include Energy Transfer, MPLX, and Plains All-American Pipeline. They all offer the highest consistent dividends on average than the other types of investments we've looked at. Then finally, one more type of investment that I'll mention here are called yieldcos. These are companies that generate cash flow from green sources of energy, including solar, wind, and water. I'd say on average, these companies tend to yield a lot less than the other things that we've looked at so far, but they can still be worthwhile investments because most of them do still grow their dividends pretty consistently, and if you are an ESG investor, this would be a worthwhile kind of investment, I'd assume. Here's some examples of some yieldcos that might be worth checking out. So as you can see, there are plenty of options out there that exist for both dividend growth investors and income investors. Be sure to do your own research on the aforementioned companies and come to your own conclusion before making any investment. But with that being said, that's going to conclude today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.